diversity. Variety is the spice of life. Diverse choices on the buffet table make for a satisfying feast because you can choose just what you want. When faced with the vast smorgasbord of financial instruments to choose from, this video lays out a recipe for making choices for managing risk, increasing your return, or both. The essential ingredient is diversity. In this financial context, that means owning different types of financial assets. Diversifying is a technique we can use to either reduce our risk, increase our return, or some combination of both. We can accomplish diversification by holding diverse types of stocks. For instance, let's assume we were only going to invest in 2 stocks, an umbrella manufacturer and a swimwear maker. Let's simplify the weather into rainy and sunny. Those 2 conditions in our example completely describe all possible future economic scenarios for the 2 companies. If you only invest in the umbrella company, a dry summer with little rain would likely make your umbrella company stock perform badly. On the other hand, if you only invested in the swimsuit manufacturer, a wet, rainy year would be a disaster. We measure the risk of a stock by the standard deviation of the returns. Since stock prices tend to rise and fall within a range, predictably deviate up and down, we can set standards for how far above and below the expected return each stock will move. For normally distributed stocks, about 2/3 of the time the individual returns will fall within plus or minus 1 standard deviation of expectations. What does that mean? Let's say the expected or average return for both stocks is 10% and their standard deviation is 50%. We know that 2/3 of the time, the actual returns will be between minus 40%. 10% minus 50% equals minus 40%. That is minus 1 standard deviation, and 60%. 10% plus 50% equals 60%. That's plus 1 standard deviation. That is a pretty broad range, and we will only be in that range 2/3 of the time. That doesn't give us much certainty about what return we will get in any given year. That uncertainty is risk. Instead of buying one stock or the other, what if you put 50% of your money in each stock? You could, in theory, perfectly offset the umbrella company's losses for that sunny, rainless season, or the swimwear maker's losses during a wet year. The 2 stocks move up or down, that is, vary in their value due to outside forces like the weather. We define this relationship as a correlation. In our example, the variation in price is the exact opposite and equal. The umbrella stock goes up in stormy weather exactly as much as the swimsuit stock sinks when the sun does not shine. The 2 stocks are said to be negatively correlated. Since these stocks tend to move in opposite directions by the exact same amount, we can eliminate all risk by investing half of our money in each stock. When the umbrella stock is down, our swimsuit stock will be up by the exact same amount. Our portfolio has no risk, but it is comprised of 2 companies that are fairly high risk if held by themselves. Perfect negative correlation, as shown in this example, is rare. You will be happy to know that diversification still works as long as stocks are not perfectly positively correlated. When stocks are perfectly positively correlated, there is no magic from diversification. Your risk is just an average of the risks of the stocks in the portfolio. In this example, we used 2 companies that have a perfect negative correlation because we wanted you to understand the importance of correlation in determining the risk of a portfolio. We can still reduce your portfolio risk by combining stocks that may move in the same direction but by different magnitudes. For instance, a restaurant with mostly outdoor seating will still have business on a rainy day, but will fill fewer tables. The weather affects the profits, but to a lesser degree than for the swimsuit company. Let's look at another addition to our portfolio of 2 stocks. What if we consider buying stock in a company that manufactures satellites? If one of their birds go down due to a manufacturing error, they lose millions. A high-risk stock for sure? Well, not really. Not if you look at how the stock impacts our portfolio. Our previous example, the weather, is going to vary constantly, but it is likely not related at all to the performance of a satellite. In other words, it is not correlated. Because of this lack of correlation, being unaffected by the weather, our portfolio can benefit even further from this company. Now you can begin to see how diversification works. As long as you continue to add stocks to your portfolio that are not perfectly positively correlated, you can continue to reduce risk. Think about it like this. What are the odds of all three companies failing at the same time? Fairly low. Your grandparents likely understood diversification, but phrased it differently. Did you ever hear someone say, "Don't put all your eggs in the same basket"?